warm welcome to the special edition of the Global View with me, Tanveer Gill. My guest today on the show is Luke Spajic, who's Head of Portfolio Management for Emerging Asia at PIMCO, and he joins me to put the emerging market story in perspective. Remember, emerging markets have outperformed developed markets through the course of 2016, and most fund managers as well as investors believe that that could be the preferred trade for 2017 as well. Luke, it's great to have you on the show. Thanks very much for taking out the time. Now, first up, the US markets are trending at record highs while the Fed is still trying to make up its mind on when to hike rates next. The pattern is interesting because it's almost seeming like the Fed is playing a guessing game with the markets. It happened in May, June of this year before Brexit, and then in August when the Fed riled the markets with rate hike talk again. And again, they did not deliver and follow through actually on that assessment. Do you believe that it is time to follow the Fed selectively and accept that rate hikes will be very slow and very shallow to in any meaningful manner change portfolio calls?
Well, thank you very much for the invite to be on the show. So with regard to that particular question on the Fed, I think it's fair to say that PIMCO has had a view that rates would be lower for longer for quite a while. Our thesis of the new neutral has always indicated that we don't think that the Federal Reserve will hike anywhere near where their blue dots indicate many years out. That said, we actually think that 3 hikes over the course of 12 months is reasonable, and they could start in December. It's very data dependent, but they could start in December.
Sure, you're calling for a December rate hike and then perhaps 2-3 in 2017. What gives you the conviction that post the second rate hike that may come by in December, that the Fed will act more quickly or can act more quickly into the new year?
Well, the preconditions for them to be more hawkish are, they need to be convinced that they're going to get ahead of some acceleration in inflation, and that growth is strong enough and employment is strong enough for them to be able to do that. You can see from the number of votes and the number of dissenters that are on the FOMC right now, they don't have an outright majority, and it would be very surprising if the Fed would move it at a time when it doesn't validate what the markets are thinking. I'd be very surprised if they tried to move aggressively going into 2017 unless they saw an extraordinary change in the data.
Right, but Luke, what would the pace of hikes in 2017 mean for Asian markets or high growth emerging markets where money allocations have gone up through 2016? Would a hawkish Fed scale back your view on emerging markets?
Yeah, very good question and very timely as well, because the main thing to note is that, is this move by the Fed, is it being anticipated or not? And most investors would agree that the Fed would like to hike rates, and let's assume they try to, and they do through the course of 17, and they don't do it in a disorderly or a very rapid way. So when you take that as given, then you look around, and emerging markets, actually the growth rates are beginning to improve. Even countries like Brazil and Russia are moving out of recession in 2017. The Asian economies are growing steadily. Certainly, we're at a 15-year low in Asian growth, admittedly, but the growth rates are still in the 4 to 5% range across the board, and China is still, according to official numbers, still in the 6s. So fundamentally, things are pretty strong. The technical picture is even more interesting because developed market assets need to be able to cope with a move in the Fed going up. And certainly equity markets need to cope with that kind of move. But if you look at emerging markets, growth is there. Yields are a lot higher than developed markets, especially when you have so much of developed markets in negative rate space. And most importantly for emerging countries, they will rely on their currencies to adjust if they have to. No one's really defending any kind of currency regime right now. Maybe the Chinese are trying to, but really most of emerging countries will allow their currencies to adjust, which gives them that extra degree of flexibility. But let me caution that if you have a very hawkish Fed moving very fast, it would unsettle all markets.
Right. Another variable that could impact portfolio calls would be the impending US presidential elections. Now, the market can react to either a Trump victory or a Hillary victory, essentially being a binary event. How do you think, market participants would prepare themselves for the event risk that lies ahead?
Well, in case of a Trump win or a Clinton win, we have to recognize one simple thing. Valuations today in risk assets, in emerging markets, in credit markets, are a lot tighter, a lot richer than they were 6, 7, 8 months ago. So regardless of the outcome, we are recommending that risk be dialed down in any case. And at the same time, when we look around and think, where do we have really high conviction views right now? In interest rate space with rates this low, it's not an abundant place right now to have very, very high conviction views. Currencies, a lot harder to call too. A lot of the big moves happened last year. We've seen some reversals this year. A lot harder there. So the one area that we think is interesting is obviously the credit markets offer value, but not as much as they did 3-6 months ago. So the overall conclusion would be, going into the final third of the year, dial down risk and let's see how markets evolve. Let's see if there's a bit of dislocation, and then buy things that come up a lot cheaper.
Let's talk about a recent note that highlights that there's a constructive case to buy emerging markets. How do you classify the risk-adjusted return opportunity within EMs across equities, debt, and currencies? Where is the alpha bias? And I just want to bring up this graphic plate for the benefit of our viewers, where you clearly highlight where the opportunity lies within emerging markets across asset classes. So the upside potential that there is across equities, currencies, or bonds versus the kind of loss probability that you're working with. Could you explain that?
Yeah, sure. So I think the discussion around favoring EM is one to do with a secular or a structural tilt. We have already seen a significant move in valuations this year from January, February, and even at this level right now, we'd probably be dialing down, like I said earlier, some of our risk, not just across the board, but in EM as well. When we look at what's interesting across the debt complex, Brazil and Russia in external debt still offer value. When I talk about the complex, I mean the sovereign, the quasis, and even some of the corporates as well. There's value there. In currency, in terms of local rates, Brazil looks interesting in local rates, and given the kind of fiscal projections that are coming through and what they intend to do, there's some value there. I think the main thing when we look across emerging markets, that we have to say, look, there are very, very low growth rates and low yields in developed markets, and negative rates have definitely shifted not only the mindset, but also the goals. Investors are now trying to find more risk-adjusted returns outside of their conventional asset class, and going into emerging markets, given that's where the growth is, given that's where the supply is coming, is a natural outcome for them. On equities, emerging market equities over the last 4 or 5 years have underperformed significantly relative to developed markets. And from here, we do see a significant catch-up trade. So we find a lot more value across the board in emerging markets equity beta relative to developed markets. I'd wrap it up by saying, look, my expertise is on the debt side, and I think that there are lots of opportunities for investors across emerging market debt, but the issue there is scaling it and having a well-diversified enough basket across all these emerging debt markets.
Sure. And within emerging markets, where are you bullish and why?
Well, we like Brazil, and we like Brazil for a couple of reasons. I think that the coming out of recession is one thing, putting a lot of the political risk behind them is another, but also having some kind of significant goal ahead of them that they need to get the fiscal affairs in order, and there are challenges and hurdles that need to be met there. But the valuations in Brazil, again, not as cheap as they were 6 months ago, 9 months ago. They look interesting in local rate space and some of the credits. Russia as well, from an external debt perspective, has done well. The oil price has helped. They are still suffering from sanctions, and they still have political risks. But at the end of the day, for us, from the Russian space, we think there's value in certain parts of the corporate credit market and in the sovereign and quasi space. So it's something that not as big as it was before, but certainly something that we're still focused on. And if we look at Asia, one thing we're not focusing too much on right now for a value opportunity is China. We don't think it's necessarily that interesting, and we're spending a lot more time on India, particularly in rates and currency.
Right. Luke, what is driving the emerging market view right now? Because if you look at Brazil and Russia, I mean, they seem like oversold markets correcting themselves, which is why the big rally across asset classes there. How much have underlying fundamentals changed there to warrant a shift in view, given the fact that, oil still is a bit of an imponderable? Yes, prices may go up from here, but there's still an oversupply problem. And both these economies are dependent on oil.
Well, first of all, I mean, in terms of the oil price, we should have seen the lows earlier on this year, and we're hoping that the oil price trends in a range-bound way for the rest of this year into next year. So not too far from where we are right now, with a slight bias higher. I think for both of those countries, I think that the most important takeaways are things that they do have control over, especially in Brazil with regard to the fiscal position and the way in which they need to navigate the next year or two, and getting out of a risk position where they may be fiscally dominated. And so far, the signs are that they are making good progress in that capacity on the fiscal side, but they need to make some very, very big steps going forward. Russia is one where the growth rates and the recession has suffered, have been pretty severe, and they are politically sometimes on the wrong side of the fence, and this is where they get a lot of negative press. But really, from a credit standpoint, the companies and the sovereign itself should be able to withstand, given current valuations of commodities, they should be able to do okay. And again, recession is something they should be putting behind them for 2017. Both coming out of recession, fundamentals improving. A lot of investor interest actually this year has been pretty strong, and a lot of investors spent a lot of time on Russia and Brazil, and I think that could be the story that carries on for the next 6 to 12 months.
Oh, that's a fair point, but I just want to understand how much does the money flow to emerging markets be a trade and a desperate trade in search of yield versus improving fundamentals? I mean, how does one explain how Turkey, despite the coup, the political uncertainty and the risk that there is, has seen a rally in bonds and a bounce back in the lira? I mean, Moody's came out just a few days back and downgraded Turkey to junk. Even so, there is enough appetite among emerging market investors and some of the global investors to look at select assets in the region.
Well, there's definitely been an overwhelming change in the technicals, not just in emerging markets, but across all corporate credit markets and equity markets this year. Again, if you go back to where we were in January, February, markets were extremely difficult to trade. They were down quite a lot. Markets were illiquid. And we've had a lot of revision through the course of this year. And we had one big factor like Brexit, for instance, in the middle of this year, that was threatening to derail markets significantly. Now there's a US election coming up. There's another risk factor there. So there have been lots of things during the course of this year that we've had to worry about. But when you think about what's happened, especially in Asia, the technicals have been overwhelmingly strong. There's been an insatiable appetite for yield. Investors looking to lock in yields, and yields have come down through the course of this year as well. It's been a pretty strong year for fixed income broadly. But I think two factors to keep in mind. One is that with the fall in developed market yields, investors have been forced to go out and look for opportunities elsewhere. And second of all, given growth projections into next year, it feels like 2016, 15 to 16 was the low, and we are beginning to pick up into 2017. So growth rates are picking up, and investors have kind of rushed in to buy some of those opportunities that looked very, very cheap at the start of this year. And things are beginning to look fair across the board, which is pretty much where we are right now.
Okay, let's talk India. What are you doing with your India portfolio, and have you increased investments to the region?
We like the currency and we like the interest rate market. We don't like the interest rate market today as much as we did 6 months ago. So if anything, we've dialed down our India risk slightly. But from a currency standpoint, we still like the currency. Even there, we've dialed down a little bit. But it's one of the standout strong stories, not just in Asia, but even across the world in currency space.
India, for as long as I can remember, since the new government came into power, has been building the case for a ratings upgrade. Do you think growth trend roughly at about 7.5%, now there is potential of 8% as well, management of twin deficits plus improving investment climate merits the case for India's sovereign rating to improve?
Yeah, it's moving in the right direction. It may be a story for 2017, but when you think about, what is it that will gain the upgrade? You'll focus on structural reform, and passing the GST was a landmark move. The improving external imbalances have come a long way, and especially with the oil price not moving too far up from here is a significant help. The growth rate, although there are some issues around whether the numbers are entirely accurate, I think you get that kind of problem with a lot of emerging countries. I think the numbers suggest a pretty strong and robust across the board growth rate, and finally inflation. And if the plan that's been put in place, the framework that was put in place by Governor Rajan, if that is stuck too rigidly, I think that all those factors point towards a very strong likelihood for next year. But we'll see how the story evolves over the next few months.
Sure. And what do you expect from the RBI under the MPC model? Three members are from the government, and they're all respected economists. Plus, there are three members from the RBI, the governor as well as the deputy governor included, and they'll all come together to decide, the future course on rates. Do you see transition challenges?
Well, the most important thing is we're going to be focusing on what kind of signals come out from the RBI itself and from the individual Monetary Policy Committee members. We want to see, is there a gap between what they're saying and what they do? Is there any threat to the architecture or any way in which this will be a divided MPC? I think it's very interesting that if you look around the world at most monetary policy committees, you will see a division between doves and hawks, and that's a natural thing because people have different views of how an economy should work and where rates should be. And obviously the governor has the critical vote in terms of swinging things. So the most important thing is going to see how they handle the first 3 to 6 months and then see how they signal things. And let's make that judgment in terms of what they do and how they lay things out very, very early on. There is a framework. We expect it to be adhered to and implemented. That's what gives investors confidence, knowing that this is a game plan that everyone signed up to. So that's how we're going to assess how things are progressing.
Right. Within emerging market bonds and currencies, how do you view the Indian benchmark government bond as also the currency which has been remarkably resilient?
Yeah, we still like the currency. We still like rates. Admittedly, we scaled down our exposure in both, but we scaled down exposure across a lot of rates and currencies in emerging markets. But again, the growth rate is intact. The external imbalances have improved and they're still there, and inflation is still relatively well behaved. And of course, there is going to be a little bit of uncertainty with a new bunch of people involved. So we'll step back a little bit and we'll see how these things evolve. But I'm quietly confident. I think the team will just keep things going, and we may go back into buying some of these securities going forward.
I also just want to touch upon, Luke, with you about the outlook on the banking sector in India. Now, the revamp is in the works for the state-run banks. Private banks are adequately capitalized to benefit from the upturn in the credit cycle as and when it happens, maybe perhaps in the second half of this year. And now the government has issued new norms on real estate investment trusts as well as infrastructure investment trusts. Are you looking at any of these opportunities closely to actually invest in the market?
Not right now. In all fairness, I think a lot of capital associated with banks in Asia, whether it be Chinese or Indian or other ones, a lot of the bank capital securities look quite rich to us on current valuations. And some of the new issues that have come out over the last 4 to 6 weeks have not performed very, very well, which is a kind of signal that the valuations aren't quite right. With regard to India in particular, we think there will be a lot of supply coming in bank space, especially what they call the A tier 1 securities, the bank capital securities. So it's not a time where we necessarily have to rush in and do much. I think the most important story for India is to figure out, what is the leadership going to be of all these banks? Do they all have the right leadership in place? And second of all, do they have a plan that is fully endorsed by the government and the RBI for them to restructure themselves going forward? It doesn't make very good reading when you see an economy with this kind of growth rate to have so many non-performing loans. And I think for the system to move ahead, maybe infrastructure spending needs to come a little bit needs to be brought forward, and that may help liquefy a lot of the economy, and that may help the banks and some of the bad loans as well. But right now, it's not something that we want to be investing in rapidly. We'll sit back and wait and see how it evolves. We're watching it quite carefully.
I also want you to comment on the cleanup act that state-run banks are undergoing. What have you made of the bad loan mess, how it's being tackled between the government and the RBI, and what kind of opportunities are you sizing up in the sector as and when a turnaround comes by? Because the market clearly seems to be excited about this story.
Yeah, so in personal experience, having watched banks for over 20 years and seeing how stories evolve, and having spent a lot of time in Europe looking at the banks in particular, banks are never necessarily resolved in one go. So it takes several goes to make sure the banks are done properly. There's an initial plan, adjustments get made, capital gets injected, and then there's a little bit of an evolution there, and then they go again. So I think the most important thing is to have a plan in place where there's a regular screening and monitoring how well the banks are doing going forward. This is not something that gets altered overnight. It may feel like it's a big change initially, but it just takes a lot more time than investors, than most people think, and investors won't necessarily rush back. Like I said, there is a lot of supply to come in terms of paper, and all that supply needs to be absorbed, and we'll see how it gets priced and how it performs. I just think it's very, very early. I think there's a lot more time here that can be spent on just waiting to see how things evolve.
Sure. Luke, then my natural follow-up question would be, how much time would you give the state-run banks if you believe that the cleanup act is still in the early stages?
Good question. Certainly, over the next 6 months to a year, it'll be interesting to see how these reforms in their plans get implemented, and most importantly, I'm very, very keen to see how the bank capital gets raised, where it gets priced, and the kind of investors that get involved, and see who really has the highest conviction in these stories. And let's see how the equities perform too. It's all going to be about the price action and the conviction that the markets have in how these stories evolve.
Right. And finally, as we wind up, just want your broad call on how you're approaching trade for the next 3 months. You're going to be cautious, largely stepping into the US presidential elections, a bit risk-off. And then, of course, we'll evaluate your portfolio strategies accordingly, given the outcome of the event, thereby reviewing your focus on what you need to do with your India exposure.
Yeah, and I think we could potentially build a case for building more risk sooner. But I think what we would say is that this year has been a remarkable turnaround in pricing, and some investors have done very well out of this. And the valuations right now are not as appealing as they were before, and there seem to be one or two things ahead of us that could derail the rest of the year. And I think the US presidential election is one of them, and all the kind of noise around that. Potentially a Fed hiking, or the language changing significantly, or the data becoming very, very positive is another one. And I think the third and final thing to think about is just think about liquidity conditions. In the last third of the year, let's see how the markets behave. Let's see how they combine all these risk factors together, and whether investors are happy holding everything they own, or whether they get even more risk averse going into the final part of the year. I think the valuations are going to be the biggest challenge, and if they come back in our favor, then we'd be more than happy to buy things that we consider cheap. We have targets and ranges, and if they hit those targets and ranges, we will happily buy.
Luke, thanks very much for taking out the time to speak with us. Really appreciate your views on emerging markets and India in specific.
Splendid. Thank you very much for your time.
Well, with that, we come to the end of this special edition of The Global View. Thanks very much for watching the show.
Find us on Facebook at facebook.com/ETNow, and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/ETNow.